You are not going to become rich because you are clever. You are going to become rich, if you ever do, because you stop doing stupid things for a very long time. People want some magical investment. They want the secret hedge fund, the hot stock tip, the little trick. They hate the boring answer. Here is the boring answer that happens to be true. $10,000 invested correctly with discipline can become $1 million in about 30 years. That is not optimism. That is arithmetic plus human behavior. Arithmetic is easy. Human behavior is not. The financial world is full of people selling you excitement. Excitement is expensive. Boredom, done right, is very profitable. Let me start by insulting you a little, because that is the only way you will listen. If you are like most people, you will waste $10,000 very easily over the next few years. You will spread it out so thinly that you will not even notice. Streaming subscriptions you forgot about. Phones you do not need. Eating out because you cannot be bothered to cook. Cars that impress people who do not care about you. Vacations that evaporate the moment you come home to the same life you left. You will tell yourself stories to justify all of it. You will call it living a little or rewarding yourself or self-care. Meanwhile, you will say you cannot invest because you do not have enough to make it matter. That is nonsense. The truth is you do not respect small amounts of money, and money does not reward people who do not respect it. At the same time, you are trapped in a system that trains you to stay broke. Your school taught you how to pass tests, not how to buy assets. Your friends talk about what they bought, not what they own, that pays them while they sleep. Your culture glorifies consumption and ridicules delayed gratification. You are not failing because you are stupid. You are failing because you are surrounded by bad examples and you copy them. Then you hear somewhere that $10,000 can grow to $1 million, and your mind rejects it. It sounds like a sales pitch. It sounds like a fairy tale. What you have never done is sit down with a pencil and simply run the numbers. If you take $10,000 and compound it at 15% per year for 30 years, you arrive very close to 1 million. The number's about 660,000 if you never add another dollar, and over 1 million if you add a few hundred per month on top. If you manage 20%, which is rare but not impossible for a very disciplined investor with a small amount of capital, that 10,000 becomes more than 2 million. People say, that is unrealistic, Charlie. You cannot get 15% a year. That is interesting, because Berkshire Hathaway compounded at about 20% for decades. You did not think Warren and I were magicians, did you? We bought good businesses at fair prices, and we did not do idiotic things. Here is the uncomfortable part. You look at those percentages and think the problem is the return. In reality, the problem is you. You will not hold for 30 years. You will get bored after 18 months. You will panic during the first big crash. You will chase something flashier the minute your neighbor tells you about his cryptocurrency that doubled in a week. You say you want compounding, then you treat it like a slot machine. Compounding works only for people who can sit still. Think about what happens in the real world. You get to your late 20s, maybe your early 30s. You are working. You feel behind. You feel pressure. You want to catch up fast. That phrase has destroyed more wealth than war. So you do something dramatic. You speculate. You confuse volatility with opportunity. You turn the stock market into a casino because you are impatient with arithmetic. What you should do is insult your own future self less. Let me spell out the simple arithmetic, then we will talk about the hard part, behavior. $10,000 at 10% annual return for 30 years is about $174,000. Not bad, but not $1 million. The same 10,000 at 15% for 30 years is about $660,000. The same 10,000 at 20% is about $2,370,000. Now add regular contributions If you invest just $300 a month for 30 years at 10%, you arrive near $680,000. At 15%, that becomes over $2 million. Combine it, 10,000 starting sum with regular small additions, and the numbers get absurd in a very quiet way. The constraint is not the math. The constraint is discipline over 3 decades in a world designed to destroy your discipline every hour of every day. People love to imagine that they will be different later. Later, they will be organized, calm, rational. Later, they will start investing. Later, when they earn more. Later, when debts are gone. Later, when markets are less crazy. Later never arrives for people who think like that. Life always supplies another excuse. The real secret is very simple and very offensive to your ego. If you cannot invest $10 now, you will not suddenly invest 10,000 later. You do not behave differently with big numbers. You just do bigger versions of the same foolishness. So let us walk through what invested right actually means, because if you get that wrong, 30 years will just be a long, slow disappointment. First, you need to accept a basic truth that most people never internalize. Money is a machine that works for whoever owns the machine, not for whoever works the hardest. You can shovel coal for 80 hours a week, and you are still using your body as the machine. The day you stop shoveling, the income stops. You have built nothing that survives you. Capital is different. Capital is like a worker that never sleeps, never eats, never complains, and never gets tired. If you own good assets, you have hired a little army of invisible workers. They get up every morning and try to earn you more money. You can become rich by using your body and your time. You can become much richer, much calmer, by using your mind to acquire assets, then letting time and other people's efforts do most of the work. If you take $10,000 and spend it on a car you do not really need, you have bought a rapidly shrinking pile of metal and plastic. If you take that same $10,000 and buy a piece of a productive business that earns profits, that business is working for you whether you go to the office or go to bed. It is astonishing how many people never make that mental switch. They think, what can I buy that I can see? Instead of, what can I own that will quietly work for me? Invested right means you are buying productive assets, businesses that sell real products and services at a profit, with some advantage that is hard to copy. It does not mean you are buying lottery tickets with a stock symbol. Most people do not invest, they speculate. They treat price as information and ignore value. They stare at charts instead of balance sheets. They become excited by movement and bored by quiet compounding. That is like judging a farm by how often the soil moves instead of by how much grain it produces. Invested right also means you avoid permanent loss of capital. I am not worried about prices going up and down. That is just the ocean breathing. I am worried about blowing up. If you lose 50%, you need 100% gain just to break even. If you lose everything, the game is over, and the compounding engine stops forever. So how do you avoid permanent loss? You do a few very boring things over and over without fail. You refuse to use heavy leverage. Debt turns fluctuations into wipeouts. It takes a temporary storm and turns it into a shipwreck. You refuse to buy things you do not understand. If you cannot explain, in a few plain sentences, how an asset makes money, who pays, and why they will keep paying, you are not investing, you are just hoping. You insist on a margin of safety. If a stock is worth about $100 per share, by your conservative estimate, you want to buy it at 70, not 90. That gap is your protection against all the ways you might be wrong. Now we get to the really hard part, 30 years. 30 years is not a spreadsheet. It is your entire adult life. In 30 years, you will change jobs several times. You will have good bosses and bad bosses. You will probably have some kind of relationship disaster. You will have health scares. You will watch friends get lucky in stupid ways and unlucky in unfair ways. You will live through at least one major financial crisis that makes you feel the world is ending. During all of that, the market will go through long periods of joy and long periods of misery. Prices will crash by 30, 40, 50% at times. The newspapers will scream that capitalism is over. The talking heads will predict doom or euphoria, sometimes on the same day. Holding on during that is not an intellectual problem. It is an emotional one. That is why people fail at compounding. They think they are building a bank account. They are actually building a test of character. To turn 10,000 into 1,000,000, you do not need genius. You need a stubborn refusal to interrupt compounding, even when the entire world seems determined to shake you out. People love to fantasize about getting 30 years of returns. Then they forget that to get 30 years of returns, you have to endure 30 years of inconvenience, boredom, and temporary pain. Let me tell you something that happens again and again. It is almost comical. Someone invests for 5 years. They endure a couple of small downturns. The money doubles. They feel smart. Then there is a big crash. Their portfolio drops 30 or 40%. Suddenly, they are not so sure. They sell. They wait for clarity. The market recovers without them. They re-enter later, higher. They have turned a temporary drawdown into a permanent loss of years. They walk around for the next 2 decades saying, the market is rigged. No, their own mind is rigged against them. To avoid this, you need a simple plan you can actually obey. You pick a strategy that is rooted in reality, broad ownership of productive businesses through low-cost index funds, or concentrated ownership of a few high-quality companies that you understand very well. You decide in advance how much volatility you will tolerate. You set rules for buying and rules for selling that are based on value, not feelings. Then you automate as much as possible. You invest every month, no matter what. You do not ask the market for permission. You make it boring on purpose. Because here is another unpleasant truth. If you try to outwit your own impulses in the heat of the moment, your impulses will win. You cannot be trusted under emotional pressure. Neither can I. The difference is, I know it. Now, you might be thinking, all right, Charlie, I understand compounding in theory, but how does someone actually get a 15% return for 30 years? The honest answer is that most people will not, and they do not need to. If you start young, a 10% average return combined with steady contributions is enough to make you wealthy relative to almost everyone around you. If you are more skilled, more patient, and more selective, you can tilt the odds toward higher returns. But the core is not finding magic investments. The core is avoiding terrible ones and avoiding terrible behavior. Let me give you a simple framework. First, decide if you are going to be a passive owner of everything or an active owner of a few things. If you are going to be passive, the playbook is almost insultingly simple. You buy a low-cost index fund that owns a broad slice of the economy. You keep fees very low. You add money every month. You rebalance occasionally if the mix between stocks and bonds drifts too far from what lets you sleep at night. You ignore everything else. This alone, done for 30 years, will make you far richer than the average person who chases the latest fad. If you are going to be active, then you must earn the right to be active. That means real study, reading annual reports instead of tweets, understanding accounts, looking at how a business actually earns money, how durable that is, what can destroy it. It means you wait a long time between actions. You might buy nothing for months or even years. You are like a hunter, not a shopper. You sit quietly until opportunity appears at a very attractive price. Then you act with conviction. Then you sit again. What you absolutely do not do is buy because something is going up and sell because something is going down. That is not investing. That is neurosis. Understand something. Money does not care if you are bored. The market does not care if you have not done a trade this week. Reality does not reward motion. It rewards correct decisions held long enough. Berkshire made a fortune buying a relatively small number of good businesses and holding them through thick and thin. We did not sit there trying to trade Coca-Cola every month. We bought because we thought people would keep drinking sugar water with a brand they trusted, and then we let time do what time does. Now, here is where your psychology will try to betray you. You will hear this and say, yes, that is sensible. Then the market will drop 20%. And your brain will quietly whisper, this time is different. Maybe you should sell now and buy back lower. That voice is your enemy. It will talk you out of every long-term compounding opportunity in your life, not just in money. So instead of trying to be stronger than that voice, you structure your life so that voice has as little power as possible. You keep your emergency cash separate so you are not forced to sell investments in a downturn just to pay the rent. You avoid margin debt so that no one can force you to liquidate at the worst moment. You do not watch price quotes every day. The stock market is there to serve you, not to instruct you. If you stare at it constantly, you are volunteering for emotional torture. You define success as number of years I stayed in the game rather than number of times I guessed the next move. Another important point people ignore, your human capital is part of this equation. When you are young, your biggest asset is not your investment account. It is your ability to earn more money in the future. If you improve your skills, your reputation, your productivity, your income can rise much faster than any portfolio. So you do two forms of compounding at once. You compound your money in investments. You compound your earning power in your work. The extra income flows into the compounding machine, and the whole thing accelerates. A person in their 20s who invests $10,000 once and never adds again is in an acceptable position if they pick reasonable assets. A person in their 20s who starts with very little but invests $500 a month every month for 30 years has built a small, steady snowball that will be big enough to matter, even if their returns are only 8 or 10%. Combine the two, and you start to understand why some people quietly end up rich while others loudly stay broke. Now we come to something very few want to hear. The moral side of this. Capitalism is not a kind system. It is a system that rewards those who delay gratification, manage risk, and think clearly about the long term. It punishes those who cannot resist impulse, cannot say no to status games, and cannot distinguish between an asset and a toy. If you decide to invest $10,000 and protect it for 30 years, you are, in effect, declaring you will not participate in a lot of nonsense. You will drive a slightly cheaper car. You will say no to some vacations. You will endure the mockery, or at least the confusion, of people who do not understand why you are not spending every dollar that appears in your account. You are trading short-term social comfort for long-term independence. I will tell you what independence feels like, because that is the real payoff. It is not the numbers in the brokerage statement. It is the ability to say no. No to a bad boss. No to a degrading job. No to an investment you do not like. No to a partner who thinks you will be financially dependent forever. People imagine that $1 million buys them Ferraris and watches. It buys them fewer forced compromises. Most people never taste that because they confuse visible luxury with real freedom. They spend their entire lives chained to payments, debt, and status signaling and call it living well. They would be horrified to know that $10,000, given enough time and wise handling, could have bought them a very different life. Let me give you a concrete picture. Imagine two people, both age 25. The first one earns an average income, spends almost everything, keeps a small cash cushion, and never invests seriously. At 55, they maybe have a house with a mortgage almost paid off, a car that is newer than it needs to be, a lot of entertaining memories, and not much else. They stare at retirement like a cliff. The second one, at 25, scrapes together $10,000. Not from some miracle, just from a couple of years of saying no more than yes. They invest it sensibly and keep adding $300 every month in a low-cost fund, ignoring every panic, and boom, they never withdraw. They do this until 55. At a 10% return, they now have around $700,000 to $800,000. At 15%, they have multiple millions. Their friends think they got lucky, or that there must be some trick. The trick was that they behaved sensibly while everyone else was busy reacting. Same country, same economy, same opportunities, just different choices repeated over and over. Now, I will tell you the most underrated part of compounding. It changes you long before the money is big. The moment you decide that money is a worker, not a toy, you begin to think differently about everything. You look at a $100 impulse purchase, and you see what that 100 might turn into in 20 years. Not in a paranoid way, but in a clear way. You become harder to impress and harder to manipulate. Advertisements stop working as well on you. Your colleagues bragging about whatever new thing they bought becomes less interesting. You experience less envy. You are no longer trying to win a race to nowhere. You gain a kind of quiet arrogance, the good kind. The kind that comes from knowing you are playing a different game on a different time scale for different stakes. Your relationship with risk changes too. You start to see that the biggest risk is not temporary market drops. The biggest risk is standing in the same place for 30 years. Inflation slowly eats the value of cash. Careers become obsolete. Bodies age. Crises happen. If you do nothing, you are not safe. You are melting. Investing wisely is not about chasing riches. It is about refusing to be slowly destroyed by time. So, when you hear that $10,000 can turn into $1 million, understand what that sentence really contains. It contains 30 years of saying no. No to panic, no to greed, no to envy, no to stupidity. It contains thousands of small decisions not to interrupt compounding, not to overcomplicate, not to be clever for the sake of ego. And yes, it contains some practical, almost trivial steps that most people are still too disorganized to take. Pay yourself first. Treat investing as a non-negotiable bill you owe your future self, not as an optional luxury you get to if you feel like it. Keep your fixed expenses lower than your income rises. Lifestyle inflation is the enemy of compounding. Every time you get a raise and instantly raise your spending, you have stolen from your older self. Avoid large, obvious wealth destroyers, high-interest consumer debt, chronic car upgrades, gambling disguised as trading, friends who normalize financial recklessness. Own simple, tax-efficient investments for a very long time. High taxes, high fees, and high churn are like termites, eating your house quietly over the years. Protect your downside. Have enough cash so that you are never forced to sell an asset you like at a terrible price just to survive. The formula is simple. People are not. By now, you might feel a mixture of motivation and discomfort. Good. That means you are finally looking at your own behavior instead of blaming the system. The system is not fair. It never was. But the arithmetic still works for anyone disciplined enough to use it. There is no gatekeeper stopping you from setting aside $10,000 over a few years, choosing a sensible investment strategy, and refusing to interrupt it for 3 decades. There is only the constant temptation to behave like everyone else. So here is the clarity, stripped of all romance. To turn $10,000 into $1 million over 30 years, you need 3 things. You need a positive real return over time, which you get by owning productive assets, not by holding cash and certainly not by holding depreciating junk. You need time, which you get by starting now, instead of waiting for better conditions that do not exist. You need behavior aligned with your own long-term interest, which you get by deciding in advance what game you are playing and refusing to be drafted into other people's games. Most people will not do this. They will talk about doing it. They will read about it. They might even start, but they will not finish, because finishing looks like sitting still while everyone around you runs in circles. For the minority who do it, 30 years from now will not feel like some miracle. It will feel like the obvious result of choices that were boring at the time. In the end, wealth is not mysterious. It is the reward for a small number of correct habits, repeated for a long time, in a world where most people cannot repeat anything for very long without getting distracted. The world will always offer you a faster way, a newer scheme, a hotter story. You can chase that, or you can let arithmetic and time quietly do their work. The money does not care what you choose, but your future self does. So you decide now whether that future self is going to look back and say, I could have turned 10,000 into 1,000,000, and I traded it for toys and moods, or I turned 10,000 into a machine that bought me freedom. One of those paths is common. The other is available. You do not need genius. You need to stop doing dumb things, put your capital where it can work, and then get out of its way for longer than is comfortable. That is the whole secret.